Hello everyone, my name is Blaine Pearson and I am a graduate instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to look at dividend yield and the dividend payout ratio. To begin, let's first review what a dividend actually is. So, what is a dividend? So when an individual decides that they want to get a product to market and to create a business, they need sales. And from those sales, we deduct the cost of goods sold. Right? So these costs of goods sold are the cost for the inventory, the cost to get them to market, maybe there's transportation costs involved, etc. And this gives us our EBITDA, right? Our earnings before interest, tax, depreciation, and amortization. After we subtract all of these costs, we are left with just our earnings. Now, when a company has earnings, they have two options that they can use these earnings for. They can first keep the earnings and reinvest back into a company. So, for example, if a company is a growth style company, it may choose to keep its earnings so that they can purchase more inventory, open up a new store location, create new products, R&D, etc. The other thing a company can do with its earnings is return it back to the shareholders or the owners of the company. A company does this in the form of a dividend. All a dividend is just money that the company has earned back to the shareholders. They can also issue the same effect a dividend would have through a stock repurchase, and we'll do a video on that later. So what the dividend yield answers is, what percentage do I get from these dividends? So much like you would go to a bank and purchase a CD, there is a stated interest rate. That stated interest rate is a very similar concept as the stated interest rate from a dividend yield on a stock. So to find this, we first need to annualize all of the dividend payments. A lot of times you'll see quarterly dividends and those kinds of things. We need to annualize the dividend amount. Once we have the recent 1 year of dividends, we can then divide it by the current share price. So, for example, let's say General Electric has 68 cents in dividends. The price of General Electric stock is $22.74. To find out the dividend yield, we would simply take the 68 cents in dividend payments and divide it by the $22.74 it cost for the GE stock. So in comparison to the earlier example, the CD stated interest rate, or the dividend yield when applied to a stock, is 3%. This is how much you are getting back for every dollar that you invest into GE in the form of a dividend payment. Shifting gears, let's take a look at the dividend payout ratio. Students often get these two confused. So again, our earnings are just the summation of all the dividends and stock repurchases plus what the company decides to retain to grow as a business. The dividend payout ratio is simply the common stock dividend, so how much that the common stockholders are receiving in the form of a dividend payment divided by the total earnings. So we have the dividend payout ratio divided by the earnings. This gives us a proportion of dividend payments to earnings. So typically a more mature company will have a dividend payout ratio. This is often the result of the fact that mature companies or value companies intend to issue more dividends. This is because usually they are in a stage of the business cycle where they are mature enough that they cannot earn as much money as they used to and give the earnings back to the shareholders. Again, this is Blaine Pearson, and in this video, we reviewed the dividend yield and the dividend payout ratio. Thank you for watching.